Hello everyone, welcome back. Here is Ali Talabi. So in module 2 we had two lessons. We talk about financial markets and we talk about financial intermediaries. More specifically, we talk about three funds: mutual funds, hedge funds, and ETFs or exchange traded funds. Today we are going just to wrap up this module, so I will review some hints and questions with you. First, let's talk about IPO and SEO. So we talk about primary markets and secondary markets, and I mentioned the primary markets, companies, corporations are able to raise funds. In secondary market, the already existing shares of the companies are traded. So through secondary market, there is no specific money raised by companies. However, the common mistake here is usually primary market is highly associated with IPO. To some degree that is correct, but it's not totally true. IPO is actually part of the primary market. Another portion of this market is SEO or seasoned equity offering. So if companies are asking for additional funds, this is still happening in primary market, so which is called SEO. IPO, initial public offering, is happening for the very first time when companies they look for new funds or new investment from shareholders. So just make sure you consider that IPO and SEO are both happening in primary market. It's not just about IPO. We also talk about three different funds: hedge funds, mutual funds, and ETFs. And as you see, and as we mentioned actually, the order of expense ratio is start with the hedge fund. Hedge funds, they are kind of the most expensive type of funds. The expense ratio is high, usually around 2%. On the top of that, the funds also ask for a portion of the profit or gain they are making out of their investment. And there are some other barriers, so it's not a good choice for retail investors. Usually they're asking for the minimum investment of $100,000, $150,000, which many investors are not able to actually choose hedge funds. Mutual funds are a bit cheaper, so the expense ratio is lower. Many retail investors, they can consider that. And finally, ETFs. ETFs are the cheapest type of funds. Usually, they are following a specific segment of the market or a specific index. Sometimes they are called index funds. So be careful that you are distinguishing between these three funds and you know the differences in expense ratio and the specifications of each. Another important thing is the difference regarding the differences between these funds is regarding the mutual funds. Actually, mutual funds are usually traded at the end of each business day. The net asset value, which we already talked about, is determined at the end of the day. So you cannot buy or sell part of the mutual fund or shares of mutual fund. So actually, you can what you can do here is you can buy or redeem a specific part of mutual fund. However, when it comes to ETFs, when it comes to exchange traded funds, they are very similar to stocks. So you can buy and sell stocks. Similarly, you can buy and sell ETFs during the day. So, and this is happening for sure in secondary market because it's already existing in the market. As I mentioned, mutual funds just are traded once per day when the market is closed, when the NAV is known, so you know how much it's for, so you can buy or sell them. So if you look at specific ETFs, or you will see that the price of ETF can go up and down. Again, it's very similar to stock prices. So it might go up, it might go down. So you might buy higher in the morning, you can sell maybe lower in the afternoon. So this is very similar to stock behavior actually. So let's look at a few questions from this module. An investment company, that's the first question. Investment company that can repurchase shares at any time is called. So we talk about this. Mutual funds and hedge funds are, generally speaking, you cannot buy or redeem these shares. However, if you're talking about the open-end fund, it means you can buy or sell the shares of these investment companies anytime. So these are open-end fund. So the answer for sure will be open-end fund. So for the closed-end fund, you cannot buy or sell, or in other words, redeem the shares of these investment companies. So the answer should be C. The second question I have here is, which of the following are the two key advantages of mutual funds? So we talk about some advantages and disadvantages of mutual funds. We talk about diversification, we talk about the professional management, and also we talk about the low initial investment required to invest on these mutual funds. Here, just I'm asking for two of those advantages. So first, let's talk about diversification, which is correct. Taxes. Taxes is one of those items which actually is disadvantage of mutual fund. We talk about double taxation for any gain or proceed or capital gain or dividend you receive from mutual fund. You need also to pay taxes. So we talk about the corporate level tax. We also talk about the mutual fund level tax. So you see, it's not favorable. B, low initial investment, which is correct. Professional management, which is correct. So it seems B is the answer we're looking for. C, talk about the liquidity and high initial investment. High initial investment is actually disadvantage. It's not good for investors. So C shouldn't be an answer. D, professional management. Taxes. Again, you see taxes. That's it. That is not favorable. So that's actually a disadvantage of a mutual fund. So the answer final will be B. So let's look at the third question. Which one of the following describes an investment company that generally has an aggressive investment strategy and is very difficult for retail investor to invest on? So we talk about three different funds, and I mentioned among those, hedge funds are very challenging for retail investors to invest on. Why? Because usually the initial investment is very high, so not every investor is able to invest on those. On the top of that, they apply or they use very complicated investment strategies, and they're looking to invest on derivatives, options, futures. So they want just to take high risk in the hope of getting higher profit. So the answer here should be C, or hedge funds. Finally, short-term financing decisions are executed in the. So we talk about different financing decisions. We talk about long-term, short-term, and we talk about different markets. As I mentioned, when you talk about those securities which they have short maturity term, I mean shorter than 1 year, usually these are traded in money market. When you talk about those securities which they have a longer maturity date, for example, we're talking about bonds, or you're talking about stocks, we're talking about the capital market. So here specifically we're talking about the short-term financing decision. These are executed in money markets. So C should be answer. B is talking about the primary market. That's a different category when the company is looking to raise funds. This is happening in primary market. We talk about examples such as IPO and SEO. Forex market or foreign exchange markets, when you are buying or selling different currencies. This is happening in Forex or foreign exchange market. So the answer should be C. That's it. So we wrap up the second module. Talk to you soon with the third module. Take care. Here is Ali Talabi.